Have you noticed that almost every major conversation in global finance eventually comes back to one question? Why is gold continuing to attract so much attention even after reaching historic price levels? For years, investors were told that gold was simply an inflation hedge, a defensive asset that performed well only during periods of fear. But today, something much bigger appears to be unfolding. Gold is no longer just reacting to inflation reports or interest rate decisions. It is becoming part of a much broader discussion about the future of the global financial system, government debt, monetary policy, and confidence in fiat currencies. Welcome back to Macro Bullion, where we break down the world's biggest macroeconomic trends with facts, historical context, and independent analysis. If you enjoy long-term market research without hype or sensational headlines, consider subscribing because every week we explore the forces shaping gold, silver, central banks, and the global economy. Let's begin with one simple observation. Every financial system ultimately depends on confidence. Confidence that governments can manage their debt, confidence that central banks can control inflation, confidence that currencies will preserve purchasing power over time. When that confidence begins to weaken, investors naturally start looking for alternative stores of value. Throughout history, one asset has repeatedly returned to the center of that conversation: gold. According to the source transcript, one of the major arguments is that today's rise in gold is not simply about inflation, but about the long-term expansion of money creation and government debt. The discussion suggests investors are increasingly questioning whether traditional monetary policies can continue indefinitely without affecting the purchasing power of paper currencies. Think about the scale of the challenge facing governments today. For decades, economic growth has often been supported through borrowing. During recessions, governments spend more to stimulate demand. During financial crises, central banks inject liquidity to stabilize markets. During unexpected shocks, fiscal deficits expand again. Each intervention may solve an immediate problem, but it also adds to the long-term debt burden. The transcript points to the rapid growth of U.S. government debt and rising interest expenses as evidence that policymakers may eventually face increasingly difficult choices. Now, debt itself is not automatically a crisis. Large economies can carry significant debt for long periods if investors remain confident in future growth, tax revenues, and institutional stability. The real question is whether debt grows faster than the economy that must ultimately support it. When interest costs begin consuming a larger share of government budgets, policymakers face limited options. They can reduce spending, increase taxes, borrow even more, or pursue policies that keep borrowing costs under control. Every option involves trade-offs. This is why many macro investors spend less time watching daily stock prices and more time studying fiscal policy, central bank decisions, and sovereign debt markets, because these forces shape the investment environment for years, not days. The source also discusses the possibility that central banks could eventually rely more heavily on policies designed to keep long-term borrowing costs from rising too quickly if debt servicing becomes increasingly expensive. Historically, one policy that receives attention during these discussions is yield curve control. In simple terms, yield curve control refers to a central bank actively influencing longer-term government bond yields rather than allowing markets to determine them entirely on their own. Supporters argue it can reduce government borrowing costs and stabilize financial conditions. Critics argue that prolonged intervention may distort market signals and eventually reduce confidence in the purchasing power of the currency if used excessively. The transcript presents this as one possible long-term scenario discussed by several macro commentators rather than an established policy decision. That distinction matters. One of the biggest mistakes investors make is confusing scenarios with certainties. Macro investing is never about predicting one inevitable outcome. It's about evaluating probabilities. If government debt continues rising, if deficits remain elevated, if borrowing costs become increasingly difficult to manage, then policymakers may eventually face choices that look very different from those of the past decade. Whether those choices involve fiscal reforms, monetary adjustments, or entirely new policy frameworks remains uncertain. And uncertainty is exactly where gold often attracts renewed attention, because unlike paper currencies, gold cannot be created by a central bank. It has no issuer, no earnings report, no quarterly guidance. Its value comes largely from scarcity, history, and the confidence people place in it during periods of economic transition. But government debt is only one part of this story, and the next question is even more important. If confidence in paper currencies gradually changes, where does that capital actually go? And why are both institutional investors and private companies beginning to think differently about physical gold than they did just a few years ago? That's where our analysis becomes even more interesting. The answer begins with one simple word: trust. Financial markets operate on trust every single day. Investors trust that governments will honor their debt. They trust banks to protect deposits. They trust central banks to maintain the purchasing power of money. As long as that trust remains strong, the financial system functions smoothly. But when uncertainty begins to rise, investor behavior changes. People don't necessarily abandon traditional assets overnight. Instead, they begin diversifying into assets they believe are less dependent on political decisions or monetary policy. That's exactly why physical gold has returned to the center of so many macroeconomic discussions. According to the source transcript, several large institutions and private companies have continued increasing their exposure to physical gold rather than relying entirely on financial products linked to precious metals. The transcript specifically highlights Tether's reported accumulation of physical gold as one example of this broader trend. Whether you agree with every investment decision made by these organizations isn't really the point. The important observation is that sophisticated market participants are increasingly treating physical gold as a strategic reserve asset instead of simply another speculative investment. That raises an interesting question. Why physical gold? Why not simply own ETFs or futures contracts? The answer depends on the investor's objective. For traders looking for short-term exposure, financial products may provide convenience and liquidity, but institutions thinking decades into the future often prioritize direct ownership. Physical gold carries no counterparty risk. It doesn't depend on another institution remaining solvent. It doesn't require a promise from a government or a corporation. It simply exists. That distinction becomes increasingly important whenever financial uncertainty begins to rise. The transcript also discusses developments in China that appear consistent with a greater emphasis on physical ownership of precious metals rather than leveraged paper products. According to the source, several financial institutions have adjusted how retail investors access paper gold products, encouraging alternative forms of ownership. Now, this shouldn't be interpreted as evidence that paper gold is disappearing, nor does it automatically imply that physical gold will outperform every other investment. Markets are much more complicated than that. However, it does suggest that regulators and institutions may be paying closer attention to systemic risk than many retail investors realize. And systemic risk is exactly what long-term macro investors spend most of their time analyzing, because systemic risks don't appear suddenly. They develop slowly. Government debt expands year after year. Interest expenses gradually increase. Monetary policy evolves. Trade relationships shift. Reserve management changes. Then one day, the market begins pricing those changes much faster than anyone expected. History offers several examples. Major monetary transitions have rarely happened overnight. They typically unfolded over many years, while investors debated whether anything had actually changed. Some ignored the warning signs. Others quietly prepared. The transcript argues that today's environment may represent another period where long-term structural changes are occurring beneath the surface of daily market volatility. Now let's shift our attention to silver. Silver is often called gold's more volatile cousin. While gold is primarily viewed as a monetary asset, silver occupies a unique position because it also plays a critical role in industrial production. It's used in electronics, solar panels, medical technology, electric vehicles, high-performance electrical systems. That means silver's price can be influenced by both investment demand and industrial demand at the same time. During periods of strong economic growth, industrial consumption may support prices. During periods of financial uncertainty, monetary demand can become an additional source of strength. This dual role makes silver one of the most fascinating assets in the precious metal sector. The transcript suggests that if a long-term precious metals bull market continues, silver could eventually benefit alongside gold because of its historical tendency to outperform during the later stages of major bull cycles. Again, that represents one macroeconomic thesis, not a guarantee. Every investment involves uncertainty. Silver has historically delivered impressive rallies, but it has also experienced significant corrections. Understanding both the opportunity and the risk is what separates disciplined investing from speculation. Now, another question begins to emerge. If gold and silver continue attracting long-term capital, what happens to the companies that actually produce them? Could mining companies become one of the most overlooked sectors in global markets? That's exactly where our analysis goes next. If there is one area of the market that may be even more misunderstood than gold itself, it's the companies that produce it. When most investors think about gold, they picture coins, bars, or exchange-traded funds. Very few spend time analyzing the businesses responsible for discovering, developing, and mining the metal. Yet history shows that during major precious metals bull markets, mining companies have sometimes delivered returns that significantly outperformed the price of gold itself. Of course, the opposite has also been true. During bear markets, mining stocks have often fallen much more sharply than physical gold because they carry operational, political, financing, and management risks in addition to fluctuations in the gold price. That distinction is critical. Buying physical gold and investing in a gold mining company are not the same investment. One is primarily a monetary asset. The other is an operating business. The transcript argues that many gold mining companies remain relatively inexpensive compared with some of the world's largest technology companies, despite higher gold prices. It suggests investors may not yet be fully recognizing the improved cash flow potential that stronger gold prices could provide for certain producers. Now, that doesn't automatically mean every mining company is undervalued. Far from it. Mining is one of the most challenging industries in the world. Companies face rising labor costs, higher energy prices, environmental regulations, political risks in multiple jurisdictions, declining ore grades, and the constant need to replace reserves through exploration or acquisitions. Only the strongest operators consistently navigate those challenges successfully. That's why professional investors rarely buy mining stocks simply because gold is rising. Instead, they study balance sheets, production costs, management quality, reserve life, cash flow, capital allocation, and geopolitical exposure. Those fundamentals matter just as much as the price of gold itself. But let's zoom out once more, because today's story isn't really about mining companies. It isn't even only about gold. It's about the changing priorities of governments, institutions, and long-term investors. Over the past several years, we've seen central banks continue accumulating gold as part of their reserve strategies. We've watched governments confront growing fiscal challenges. We've observed rising geopolitical competition reshape global trade. And we've seen investors increasingly question how sustainable current debt trends may be over the coming decades. Individually, none of these developments guarantees a financial crisis. Together, however, they suggest the global investment landscape may be evolving. The transcript also references well-known market commentators who have expressed very bullish long-term views on gold. These views include projections based on debt expansion, monetary policy, and potential changes to the international financial system. The source presents these as individual opinions rather than established market outcomes. That distinction is one every serious investor should remember. Predictions make headlines, evidence builds conviction. Anyone can publish a price target. Some forecast $5,000 gold. Others believe $10,000 is possible. Some estimates go even higher. Those numbers generate attention, but responsible investors should always ask the same questions. What assumptions support that forecast? What conditions would have to occur? What risks could invalidate the entire thesis? Because markets rarely follow a straight line. Even the strongest long-term trends experience setbacks. Corrections are normal. Unexpected policy changes happen. Economic growth can surprise to the upside. Inflation can fall faster than expected. Technology can reshape industries. And investor sentiment can change much more quickly than economic fundamentals. That's why risk management always comes before return expectations. At Macroeconomic, our goal isn't to predict the future with certainty. Our goal is to understand probabilities, to separate facts from opinions, to study history without assuming it will repeat exactly, and to help you think independently instead of simply following market narratives. If today's discussion teaches us anything, it's this. Gold isn't attracting attention because investors suddenly discovered it. It's attracting attention because questions surrounding debt, monetary policy, reserve management, and financial confidence have become increasingly important. Whether those questions ultimately lead to significantly higher gold prices, a prolonged period of consolidation, or an entirely different outcome remains to be seen. The future is never guaranteed. But understanding the forces shaping that future gives investors a better foundation for making informed decisions. If you found this analysis valuable, subscribe to Macro Bullion for more independent research on gold, silver, central banks, inflation, interest rates, and the global macroeconomy. Leave a comment below and let me know your view. Are we entering a new long-term precious metals cycle, or do you believe today's optimism has already been priced into the market? I'd genuinely like to hear your perspective. And as always, remember that everything discussed in this video is for educational and informational purposes only. It is not financial or investment advice. Study multiple sources, evaluate the evidence for yourself, understand your own risk tolerance, and always do your own research before making any investment decisions.